Why IMF calls India's forex rate regime as a crawl-like means our rupee is falling very fast, but it is controlled by our RBI. So IMF call it's like it is falling like crawl-like structure. So why IMF calls India's forex rate regime crawl-like? The IMF regularly classifies every country's exchange rate system into categories like hard peg, which is fixed, soft peg, crawling peg, crawl-like arrangement, floating, free floating. In its latest review as of 2024-25, the IMF put India in a crawl-like arrangement category for 10 consecutive months. India and the Reserve Bank of India strongly disagree and say the rupee follows a managed float or floating regime. What does crawl-like arrangement actually means? According to IMF definition, the exchange rate is allowed to move, but it moves in a very steady, predictable manner like a caterpillar crawling slow and in one direction. The currency fluctuates in a narrow band plus minus 5% over 6 months in is the technical threshold. The central bank frequently intervenes to prevent sharp movements. This is different from a true floating regime like the US dollar, euro, or Japanese yen, where the currency can swing 10 to 20% in a few months purely based on market forces with little or no central bank intervention. So the IMF is essentially saying that yes, the rupee moves, but it moves too smoothly and too little. The RBI is clearly managing it tightly. So why does the RBI intervene so much? The RBI's stated policy is to prevent excessive volatility, sharp ups and downs, maintain orderly market conditions, build forex reserves when the rupee is strong, supply dollars when the rupee is under pressure. In practice, the RBI almost never allows the rupee to fall or rise sharply in one day. This gives exporters and importers predictability, but it also means the rupee does not fully reflect market forces. As of December 1, 2025, the rupee closed at a record low of 89.59 against the US dollar, yet the fall has been extremely gradual, which is crawling downward. Evolution of India's exchange rate regime timeline. So pre 1947 to 1975, which is pegged to British pound then to US dollar. 1975 to 1991 pegged to a basket of currencies secret rates. March 1992 dual exchange rate LERMS liberalized exchange rate management system. March 1993 unified market determined rate officially moved toward floating. August 1994 rupee made fully convertible on current account. Since 1993, India has officially been a managed float. The market sets the rate, but the RBI intervenes heavily. How does the RBI actually intervene in the market? The RBI sells or buys dollars through three main channels: directly through public sector banks, SBI, Bank of Baroda, etc., who act as its proxies. Second is through the future and forward market, especially non-deliverable forwards, NDF market in Singapore and Dubai. Occasionally direct spot market intervention, and the offshore NDF market has now become very important. The RBI quietly intervenes there to 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 influence expectations. So what are the non-deliverable forwards, NDFs, and forward premium? So NDFs are contracts traded offshore, which is Singapore, Hong Kong, London, where people bet on where the rupee will be in 1, 3, 6, or 12 months. No physical rupee change hands, only the profit or loss in dollars is settled. The difference between the spot rate and the forward rate is called forward premium or dollar rupee forward discount. Over the last 10 to 15 years, the 1 year forward premium has declined sharply. So April 2015, which is approx 7.5% annualized, now 2.5% or less. So this reflects lower interest rate differential between India and the US. So why does the IMF's classification matter? So it affects how investors and rating agencies view India's policy credibility. Some global funds index tracking can only invest in countries with floating regimes. India wants to be seen as a mature open economy. Being labeled crawling like feels like downgrade. So but the RBI argues emerging markets cannot afford full free float. Sudden stops and capital flights can be disastrous. So 1997 Asian crisis, 2013 taper tantrum. So India's reserves are now more than $700 billion. So if we intervene from a position of strength, not of weakness. So summary, what is really happening? So officially India has managed the floating exchange rate. In practice, the RBI manages it to so tightly that the rupee moves in a very smooth, predictable way, a dirty float or a heavily managed float. The IMF looks only at outcomes, how much the rate actually moved and how often the central bank intervened, and says this looks like a crawl-like arrangement. India says we are not targeting any level, we are only curbing volatility. So the disagreement is more about labeling than substance. India does allow flexibility but far less than truly floating currencies. In short, the rupee is floating but with very heavy swimming armbands put on by the RBI. As of December 2025, with the rupee at an all-time low of 89.59, the crawl continued slowly, steadily, and very much managed. So it is a very technical language, so I will explain in very simple explanation with everyday examples. So suppose the Indian rupee is a kid learning to ride a bicycle in the park. So different countries is equal to different parenting style. So countries like USA, Europe, Japan, the parenting style is free floating. So what happened to their currency? Parents take off the training wheels and just watch from far away. The kid can go fast, slow, fall or zoom. Whatever the road market does, sometimes the kid crashes hard, sometimes flies. In old India before 1993, there was fixed peg. Parents hold the bicycle seat tightly and run behind. The kid can pedal, but the speed and direction are 100% controlled by parents. In country India right now, 2025, it is like crawl like what IMF says. Parent promise you are on their own now, but actually they never let go of the seat. They walk slowly behind the kid, making sure the bicycle move only a tiny bit every day and never falls. The kid feel like he is riding freely, but actually the parents are controlling every centimeter. So real life rupee example to 2023 to 2025. January 2023, 1 US dollar is equal to 82 rupee. December 2025, 1 US dollar is equal to 89.59 rupee. That is 7.59 rupee drop in almost 3 years. Only about 2 to 3 rupee per year. Very slow and steady like a turtle crawling. In the same 3 years, Turkish lira falls 70% like the kid crashing and crying. Japanese yen fall 30 to 40% like kid riding fast downhill without brakes. Indian rupee fell only 9%. Parents RBI holding the seat tightly so the kid moves just 1 to 2 steps every month. So how does RBI, the parent, control it every day? Kids want to go too fast downhill, rupee falling fast. RBI quickly sells some of its dollars, give the market extra dollars, so rupee stops falling sharply. Kids want to go too fast uphill, rupee rising fast. RBI quickly buys dollar, from the market, removes extra dollars, rupee stops rising. So every day the rupee is allowed to move only a few paise, like 5 to 10 paise, never 50 to 70 paise in one day. That is why it looks like a smooth crawl. Simple summary in one line. So India says rupee is floating like a free bird. So IMF says no, it is floating but inside a small cage with RBI holding the strings. That is why IMF calls it crawl like instead of floating. So easy example, you can tell anyone the rupee is like a kite. India says the string is very long, which is almost free. IMF says the string is actually very short and RBI uncle is holding it tightly so the kite can't fly too high or crash. Thank you.